Welcome to Investment Fundamentals by RI Advice Group. Let's begin by looking at the importance of a financial plan. Investing is all about creating a plan, and a financial plan is all about you. When do you want to access your money? What's important to you? And why are you investing? These are all important questions to consider. Your financial plan is a roadmap. By being specific about your goals and what you need from your portfolio, a blueprint and a roadmap will emerge. This will give you direction and focus, which will then help you achieve your objectives. Whether you have never invested before or have been investing for years, the fundamentals remain the same. So let's look at some of these fundamental concepts now. Firstly, time in the market, not timing the market. This means investing for the long term. Markets tend to move in cycles. All sorts of things can send jitters through the world share markets, causing prices to fall from time to time. And as you will see, world events do have an impact. However, one thing to remember is that long-term trend is always up, regardless of short-term volatility. Related closely to this point, and another key concept to keep in mind, is that markets will fluctuate. But once again, it's important to remember that the longer you stay invested, the less affected you will be by short-term volatility. Have a look at the up and down movements on this short-term graph compared to that over the long term. Have you ever heard of missing the best days? We've all heard of buy low and sell high, but in reality, means few investors are able to do this consistently, and trying to can be detrimental to building wealth. On one hand, an example, you could keep your money invested throughout the whole period, and on the other hand, you could try buy high and sell low, consequently missing 10 of the best days. As we can see by the difference in figures here, being out of the market, even for a short period, can have a real impact on the overall performance of your investments. Now let's look at compounding returns, which means reinvesting the money you make back into your investments. If you make small regular contributions to your investment, this can have a greater effect. Let's look at an example of investing $100,000 at a return of 7% per annum. If you invest the $100,000 today, in 10 years' time, your money will be worth over $196,000. If you hold off for a year and then invest your money, it will be worth $13,000 less at only $183,000. Even worse, holding off for 5 years will mean you could be missing out on close to $50,000. The moral of the story? It's never too late to start, but by starting now and using the power of compounding returns, you could effectively double your money in 10 years. Have you heard of dollar cost averaging? Dollar cost averaging is a strategy of investing a fixed amount at regular intervals. This is a great strategy as it lowers the risk of putting a large amount into a single investment at the wrong time. Meet Dan and Nat. Both have $100,000 to invest. Dan decides to wait until the market is running upwards before he invests his money, while Nat decides to take a more conservative approach and reduces her risk by investing $10,000 every month, regardless of whether the market is up or down. At the end of the 10 months, Nat has made a profit of over $4,000, while Dan has made a loss of almost $4,000. So what about risk? When deciding on an investment, it's important to understand the expected risk and likely returns. Risk means different things to different people, but typically it is referred to as the uncertainty of the return or the risk of losing your money. When investing, each asset class has a different level of risk and return. As a general rule, the bigger the potential return, the higher the risk, and the longer the investment timeframe. Knowing what to expect from the different asset classes will help you decide which investments best suit your needs, goals, and investment timeframes. Investing in cash has a low level of risk and potential earnings. Shares are on the other end of the scale and have a higher level of risk and potential return. Closely linked to the different asset classes is the importance of diversification. Diversification is the spreading of investments across different assets to protect them from short-term ups and downs in any one asset class, while still accessing growth in a strong market. This graph shows how diversifying your investments means you won't need to try and pick the winners. Investing in shares both locally and internationally is a form of diversification. By owning shares, you are able to share in the success of global brands you know and use every day, and diversify across many countries. Take a typical day, for example. You woke up to a Sony clock radio, which was made in Japan. You drank Lipton tea from the UK. You then ate a bowl of Kellogg's for breakfast, which is made in the United States. You snacked on some Nestlé yogurt during the day, made from Switzerland, then switched on your Apple to check your emails, made from the USA again, and then drove home in your Nissan, which was made in Japan. As you can see here, diversification does not just relate to asset classes, but can also be considered when investing in equities. The last fundamental concept to consider is your portfolio construction. Matching your objectives with your investments is the key to a good financial plan. And remember, it may not be wise for everyone to invest in the fund or asset that has the highest return or conversely, the lowest risk. As we know, everyone has different needs and objectives. Portfolio construction involves understanding the way different types of investments work and combining them to meet your objectives. Think about your experience, goals, needs, time frame, and attitude to risk. After these have been determined, you can look at selecting appropriate investments that match all of these factors. When planning for the future, there are many things to consider. What lifestyle do you want in the future? How much are you currently saving towards your goals? Are there better ways of achieving your goals? How much more or less do you need to be saving to achieve your goals? How much money do you need to support your lifestyle? Contact us today to help you find a balance between your lifestyle today and security for the future.